Welcome to the Wealth Flow. My guest today is Neal Bawa. Neal is a multifamily investor with Grow Capitus, as well as a highly demanded commercial real estate speaker. Neal is known as the Mad Scientist of Multifamily, and he is a self-proclaimed data guru, a process freak, as well as an expert outsourcer. He treats his $1 billion apartment portfolio as an ongoing experiment in efficiency and optimization. Neal also serves as CEO at Multifamily University, an apartment investing education company with over 5,000 students attending his programs. Neal's asset management and revenue optimization techniques for multifamily are considered unique in the industry. So, Neal, welcome to the Wealth Flow.
Thanks, Keith. Thanks for having me on the show. Very excited to be here.
Absolutely. And what I like to start with, Neal, is really kind of where you grew up and what eventually led you to real estate.
Yeah, I grew up in India, came to the United States as a technologist, so I'm a geek, a nerd. I've had a full career in Silicon Valley as a technologist, ran a tech company took it from 10 employees to 400 employees and sold it at class leading multiples in 2013. And as I was going through that 15-year process, I had the big fat tech salary and the big fat tech bonus, and I live in California, so I was paying 50% of my income in taxes. And so the drive to do things in real estate basically weren't really to grow income. It was to reduce my taxation. And my first project in real estate was in 2003, but I had to build a campus for my company. And and after I built that, I saw the amazing benefits of tax of depreciation to taxation, and that got me hooked.
Yeah. Wow. Okay. And did you go straight into multifamily, or did you start in single family, or how did that start?
So, again, oddly enough, because I started in new construction, it was basically, I was building campuses for my company. There weren't any investors. It was just the company's money.
Okay.
And our CEO was guiding that process, telling me what to do. But in thanks to that, and thanks to the fact that I was actually a partner in many of those projects and I was getting depreciation in those projects, by 2005, 6, 7, my take home salary had jumped up massively, right? Because before that, I was just paying 50% to the man. And now here I was paying very little to the man. And so all of a sudden I had a lot of savings. And so my timing, Keith, couldn't have been better because 2008, 2009 is where I haven't had enough money to actually jump into real estate. So in those years, the kind of the Great Depression years, I was practically buying a property every month, right? So, trying to buy, 8, 9, 10 properties, mostly for myself, but also some for my family as well. And so started with single family, and the path really wasn't necessarily being a single family investor. That was very nice. The cash flow is incredible, but my path was along the use of data scientists. It's a data science, so I'm a data scientist, and so I was very curious to know the answer to this question. How many metros are there in the United States, in this beautiful country of ours, and which ones are better than the others for real estate investing? And every time I would ask that question, I would get a nonsense answer, or a subjective answer from people that knew maybe 2 metros or 3 or 4 or 6, and they would basically give me an answer for those 6. But no one had an answer as to how many metros are there in the US, and how to compare them. So in 2009, 2010, I became obsessed with data mining for every metro in the United States and comparing them to each other. And that's really what has gotten me to where I am today with, $1 billion portfolio and 1,000 investors.
Wow. Okay. That's interesting. So I guess, well, why don't we go there? Why don't we just, where are the metros that, your company looks to invest in, and maybe tell us some of the reasons you've chosen, that as the top metros.
Absolutely. So to sort of step back a little bit, right? When I was asking that question, nobody would give me an answer. So I hired a Ukrainian hacker, and I basically said, let's data mine all of the real estate websites that were out there back then, Zillow, Trulia, the Department of Labor Statistics, and let's take this information and put it into a statistical analysis software. It's called R, and let's see what the correlation is between profits. If Keith's investing in a city, what's the correlation between his profits and all this data, right? Is the highest correlation, Keith? Is it income? Is it job growth? Is it schools? Is it, what is it, right? Population growth? What creates the highest correlation, and in what order? So we went and did this, and we discovered that there's roughly 300 metros in the United States of a reasonable size, 100,000 people or more. Um, and so we started data mining all those metros, looking at all of the different factors that we could get our hands on. Back then, it was pretty incomplete. Now it's very complete set of factors. And we started comparing them and contrasting them. And as I started doing that, there were some very interesting aha moments as to where I should be buying. And the short answer to your question is it changes, right? So it changes on a yearly basis, on a monthly basis, but certainly it does changes on a yearly basis. But I was coming up with a list of metros that I nobody could get me any feedback on. So I'm in the San Francisco Bay Area, Silicon Valley, and I would basically say, in my statistical analysis, I'm seeing this metro come up all the time, and it's called Provo, Utah. It just keeps coming up and keeps coming up and keeps coming up, and it's clearly there's something very unusual happening in this metro, and there's a very high correlation between this metro and investor profits. And nobody could explain to me why that was. So basically, I had to start flying out to these metros and seeing them for myself. And what I found is that the highest correlation has always been the smaller metros instead of the larger metros, or they're often suburbs of larger metros. So you can have a large metro like Atlanta, and then you can have a suburb like Mableton that's about 30 miles away from downtown Atlanta, and you see a higher correlation there. So it's very interesting. And I started making an investment, and I decided I wanted to share this information with other people, Keith. So I opened a meetup group inside of my technology business. I used to have large classrooms with capacity for 100 people, and I'm thinking, oh yeah, I'm going to give this out, and 100 people are going to show up, and I'm going to be famous. And the first time I did my the data science of real estate meetup, there were four people in the room, and three of them were geeky people from Apple and Google and me, and I'm sharing this stuff, and I'm really disappointed, and I'm like, no, this is really powerful stuff, everyone needs to know this. And so I kept going, and the second time I did it, there were maybe 10 people in the room. Third time there were 20, and a year and a half later, Keith, there were 100 people in the room because my location was perfect, right? I was in Silicon Valley. Imagine how many nerdy, geeky people there are in Silicon Valley. And a year later, there's all these people, and they're looking at my data, and we're just sharing this. There's nobody that's trying to make it into a business model. And I'm buying properties based on the data, and other people are buying, and some of the guys are buying even more than me, like two, three, four times more than me, and everyone's making an enormous amount of money. And sooner or later, somebody says, we should find a way to share this information nationally. And I'm like, how do we do that? And they said, well, there's this website called udemy.com, udemy.com, and they have lots of these courses, and you should publish, your science, your data science on there. But you have to find a way to simplify it, because right now this is really data science by data scientists for data scientists, but it has to be something that is accessible to the real audience, to anyone. And I said, so what's a good benchmark for that? And they said, Keith, you should be able to, the technology basically compares cities for profits, right? What's a more profitable city? What's a better place to invest in if you don't know any of these cities? And so they said the average person should be able to make a comparison between any two random cities in 10 minutes. And I was like, wow, that seems hard. So we spent a year working on trying to make it simple enough using public sources so that any two cities in the United States could be compared in less than 10 minutes. And finally, once we had that benchmark, I created the course, I put it up on udemy.com, and I thought maybe, every year I'll get another 100 people, 200 people that'll be taking this course. And I didn't realize that Udemy actually spends a great deal of money promoting these courses. So today, in late 2023, I have 12,500 investors taking the course. It has over 1,000 five-star reviews. It is the best reviewed real estate course on Udemy. So there are 400 courses, and this is easily the best reviewed course. And so people really loved it. They loved the fact that I was able to take something that was a very dense topic and make it interesting and entertaining and easily relevant to people, where they could basically start looking at this and realizing, oh my God, these are the things that really create profit in real estate and how it changes over time. And that, sort of led to a completely different track of my life for me. as I was doing this and publishing the Udemy course, I'm still running a technology company. It's my sort of my day job, and I'm doing real estate investing on my own with family and a few friends, but I'm not really doing it professionally at this point in time. But I know that in a couple of years I'm going to sell my company, so I start thinking about what the next step is. And I didn't have to think very long because I started getting phone calls from all over the United States from people who were in real estate and that were running conferences saying, we've heard about you. You're this geeky guy that basically talks about the data science of real estate and how it creates, correlates to profits. And we've checked out your course. We really like it. We'd like you to come teach it at our conference. And I'm like, but I'm the San Francisco Bay Area. I mean, your conference is in Miami. How do I get there? And they're like, we'll pay for your ticket. We'll pay for your hotel and we'll give you a free conference ticket. And I'm like, wow, this is pretty amazing. Right. And I'm like, okay, I'm gonna show up there, but be aware, I'm not like a real estate guy, I'm a technologist. And like, yeah, we like that. We like the fact that you're not, you don't have anything to pitch, you're just sharing this information. And so I started getting all these free conference, visits and things like that. And then podcasters started appearing and started talking with me about it. And I'm like, maybe I should turn this into a business model at some point. Is this something I really want to do as a business model? So I started looking at multifamily because it had scale compared to single family, and I was very attracted by that. I started buying my own multifamilies. First, I bought small ones. I bought a threeplex, then I bought a sevenplex, then I bought a 12plex. So we sort of went up from there. And as I gained experience, I started sharing that information on these various means, podcasts, things like that. I've now been on 300 podcasts, and I've presented at over 100 conferences. And so it sort of snowballed, Keith, and none of it was planned because I was a technology guy running a technology company that was looking to get sold during that time. But on the side, I'm doing all of these activities. And in 2013, I sell the company. I have this enormous tax bill, and that's when I really jump in and start buying multifamilies. But my tax bill was so enormous that even just being a limited partner in other people's multifamilies would not have gotten rid of all the taxes. So I had to basically go the route of being a general partner where you get, a bigger share of the depreciation. And that's what really prompted my push into multifamily. And once I started doing it, I started sharing it with my list, all these people that were interested in all this, the stuff that I was doing. They all seem to want to invest with me. So it sort of snowballed from there. And here we are, 8, 9, almost 10 years after my company is sold. We've raised about $300 million for $1 billion portfolio. And we've basically invested in most asset classes in commercial real estate. Well, I'd say about half of them. So I've done office, I've done self-storage, I've done industrial, multifamily, of course, townhomes for sale, townhomes for rent, student housing, both the garden style and high rise or mid rise multifamily. So it's been a great journey, but all along, what's interesting is I've just been looking at data and making decisions based on that. And there's a bunch of people that like that sort of thing and have followed me in.
Yeah, that's pretty amazing. It's a great perspective to have, and you've seen that the data that you're looking at, whether it be multi-family, whether it be single family, whether it be some of these other asset classes that you mentioned, those are all good signs, for each of those, or is it specific to certain asset classes?
It definitely is specific. I think that we've, over time learned how to use it for different asset classes. We've learned to use it for self-storage. We've learned to use it for industrial. But the data that we publish that we feel the most confident about, Keith, is in the single family, multifamily space. And so that's the data that we have published. And Location Magic, which is a very popular course, the one on Udemy, the one on our website, that gets about, at least 10,000 people a year that are looking at it. That is specific to single family, multifamily. It's not any other asset class. I think that at some point maybe we can look at other asset classes and having a new version of Location Magic, but it primarily works for those two big asset classes, and they're by far the largest asset classes. So it seems good enough.
Right, absolutely. Well, and so tell me a little bit about, so then you started not just investing in your own stuff, you started syndicating as well. And due to the demand of people saying, "Hey, I like what you're doing here," and wanting to invest. What size properties did you start with as far as number of units, and maybe kind of explain where you're at now when it comes to, what fits your buy box.
I mean, I've done all kinds of sizes. I've done, properties. I'm building a property that's 320 units. That's, when it's all said and done and it's stabilized, it'll probably be sold for 150 million. I've done 240 units. I've done 180 units. I've done 190 units. So rarely do I do a property that's under 100 units. So most of them are between 100 and 200 units. That's sort of the box. And then I've done some that are, all the way up to 320 units. I usually will not go above that level because it's too big a property. It's problematic to manage, and especially if it's new construction, it takes a while to fill it. So that 100 to 200 units is sort of the favorite box where most of my properties tend to live in. My current mission, though, is to build to rent, which is definitely multifamily, but a different kind of multifamily. It's townhomes, new construction townhomes, and my one of my new companies, which is the one that attracts the most investors, is called mission10k.com. And mission10k.com's goal is to build 10,000 new construction townhomes in fast growing secondary markets in the US that have low property taxes.
Mm, okay. Yeah. And low property taxes, obviously, you're going to have better cash flows. What are some of the markets that you're focused on with Mission 10K?
So it's very interesting. You lose a lot of the superstar markets in the United States when you're focused on low property taxes, because what we've seen in the last year or two is this astonishing increase in property taxes in superstar markets like Texas, all the Texan markets have made cash flow unviable. You're not going to cash flow, and the taxes are so high that they're dragging down your net operating income and your selling prices based on your net operating income. So it's just making things very hard. So I've been forced to walk away from a lot of really high quality states. Texas is one, Florida is the other. With Florida, its property taxes are not as onerous as Texas, but insurance costs are wildly out of control. So these are two of my favorite markets. I think Texas and Florida are amazing. I just at this point cannot make my townhome model work on those markets. So I'm looking at other fast growing markets like Utah, Idaho, South Carolina, North Carolina, Alabama, and Arizona. I'm looking at Arkansas, Tennessee. Those are markets, and then I'm also looking at a few selected Rust Belt markets that are doing well, like Indianapolis. I'm looking at Kansas City. So those I tend to be very, very selective in when I look at the Rust Belt. But the vast majority of my markets are essentially the high growth states and cities, but I eliminate the high property tax ones, which essentially means I can't engage in Florida or Texas anymore.
Okay. And when you say high growth, can you maybe define that? What do you consider to be high growth compared to other markets, and what's maybe not as um, fast growing?
So we look at 30 or 40 different metrics, Keith, but the bottom line is the two biggest ones are going to be jobs and population growth, right? So, when I'm looking at like North Carolina, South Carolina are very high population growth. Utah is very high population growth for a different reason. Utah is mostly LDS, so, Mormons, and they tend to have a lot of kids. So an average Mormon family will have twice as many kids as an average non-Mormon family in the US. And that tends to drive population growth in Utah much faster than it does in other states in the country. We look at population growth, we look at job growth, and those two things definitely go hand in hand, though that's not always the case. And then we're looking at employment centers. We're looking at what sort of employment is coming in. Is it high margin employment? Is it the Walmart kind of employment, or is it the Google kind of employment, right? So we're looking at those kinds of locations, and once again, just looking at those numbers, the top metro in the United States is probably going to be Austin, but we can't engage in Austin for Mission 10K because its property taxes are extremely high. We're also looking at low construction costs. So some of the markets that we're going into, I'm stunned by how much growth there is and how low the construction costs are. Idaho and Arkansas are two areas that are very interesting. Rogers, Arkansas has one of the highest growth rates in the United States, period. So we tracked 323 metros. And last month, Rogers, Arkansas was ranked number one out of those 323 metros. It probably won't be number one, next month or the month before, but as long as it stays in that top 5%, that's obviously an area for us to pay a lot of attention to, and its construction costs are very, very reasonable.
Yeah, who would have thought, that would be the top area? What's driving that? What's the reason it's so high in Rogers,
Well,
Arkansas?
I used Walmart in negative sense, but essentially, Walmart employs 2.2 million people, and most of these people are unfortunately low income. So I'm not necessarily going into places that have a lot of Walmarts simply because there's a Walmart everywhere. So that there's no benefit to doing that. But Walmart had corporate headquarters all over the United States, and they decided to consolidate them and bring in their management into the Rogers market. Bentonville, which is 5 minutes from Rogers, is the city where Walmart is headquartered. So they're basically bringing in 10 plus thousand of their middle management people, and these are generally high income people, 80,000 to $200,000 in income. And they're bringing them in there, and they're relocating them, and they're giving them cheap mortgages and all sorts of things. So it's a large initiative. There's three or four other companies that are very large that are really doing well in that marketplace, like Tyson Foods, and so that's really driving the Rogers, Arkansas market. But it's an extraordinary high quality, robust market, very high quality of life. And one of the big reasons is that the Waltons, the family that owns Walmart or used to own Walmart, they're just the bigger shareholders. They are very philanthropic. So they've spent an incredible amount of time making the environment where they live much better.
Yeah, yeah, that's great. So these are all ways to find and identify markets. When you've went ahead and identified not only a market but a property, what are some of those efficiencies that you look to implement on them to get those high returns for your investors?
Depends. So whether I'm building or buying, if I'm buying, then my core focus is how do I optimize the leasing? I find that most multifamily buyers do not have a good understanding of leasing. They leave it to their property management companies. I think that's a huge mistake, but it's also an extraordinarily common mistake because we think, okay, well, the property manager knows how to lease up the property. I find most property managers are pretty awful at leasing up the property. I think they're actually pretty good at doing the day-to-day work of the property, but leasing is a sales activity, and I think that they really suck. So we have a team in the Philippines that we call the Efficiency Center, and we use that team to generate a large number of tenant leads, and we process those tenant leads and put them into the property management system, basically driving the traffic to the website, and that makes an enormous difference to the net operating income of the property. A huge difference.
Wow, that's really cool how you're leveraging technology all along the way here. That's neat. And are they reaching out to these potential tenants, yeah, pointing them in your direction, or how's that work?
Yeah, as simple as this. I mean, not Facebook paid ads, but Facebook Marketplace is one of the most efficient ways to get, people to look at your property and to rent there. However, Facebook is a conversational medium. What that means is you can't just put an ad for Facebook Marketplace because their first question is this still available? No matter what you say, you can say things like, if you see the ad, then it's available. It makes no difference. They still ask the same question. And then as soon as you answer the question and say, yes, this is available, then they have another question. And then they have another question. And often they have 4, 5, 6, 7, 10 questions before they will ever agree to schedule a call. And it costs too much money to have property management people from the United States engaged in those conversations. But what if you had a team in the Philippines that was dedicated?
Yeah, yeah, that's great. Wow. Okay. And so, what about on the ones that maybe you do as far as new construction? You said the 300 and something unit is one that you're currently developing. And what area is that in?
So that's in Phoenix. Phoenix is consistently one of the fastest growing cities in the United States. If you look at, maybe the 2017 to 2022 timeframe, those 5 years, Phoenix would rank in the top three all of those years, right? So it's a very fast growing market. Arizona has an incredible number of people moving in from California and other states. And so it's a terrific market to invest in. Now, there are Currently, Phoenix has some challenges, and a lot of those challenges are that there's a lot of new supply coming in. So there's new construction activity that's coming in, but we expect that that's going to moderate within the next 12 to 18 months. But it's a terrific market to invest in. Now, when it comes to Mission 10K, that mission is a little bit different. I am looking only to invest in markets where there's middle American salaries of 60 to 80K because I'm not building apartments, I'm building townhomes. And so I'm looking for people that want our families, maybe they've got, two dogs and two kids, but they don't have the money to buy a single family home, and their only other option right now in these smaller metros is to go out and rent an apartment, but they don't want to live in an apartment when they're a family. And so my job is to build townhomes that are reasonably priced enough. Let's call it $1,700 a month in rent, but are brand new. So they're living in a brand new townhome, and they're living inside a community of townhomes. So there's a 60, 100, 150 townhomes that are together, and all of them are rented, right? So that everyone that's living there is a tenant, but usually families. And so in those cases, the thing that matters the most to me, once again, is high growth. So I'm looking for high population growth and high job growth. That's just, that's non-negotiable. But now I'm interested in smaller markets. Phoenix has 5 million people. Well, Rogers, Arkansas has 500,000 people. So it's 1/10 of the size of the market. But the big difference is Rogers has low construction costs, extraordinarily low property taxes, and I really emphasize that, extraordinarily low property taxes, and okay, on the insurance side. It's very difficult for me to find a fast-growing market that has both extremely low construction cost, extremely low property taxes, and extremely low insurance. So I try to get two out of those three, and the two that I tend to focus on are low property taxes and low construction costs. So I'll deal with high insurance costs if I have to. That's why Texas doesn't work, because it's got high construction costs, high property taxes, and high insurance. So it's got basically three, negative check marks. Where with Florida, it's sort of two out of three. So I look for properties where it's one negative check mark out of those three. Maybe it's like Rogers, where insurance cost is very high, but property taxes very low, construction cost extremely low. Also land cost, right? So land cost in Texas right now is outrageously high, whereas land cost in Rogers is maybe a third or maybe a fourth, sometimes a fifth of what I would pay in Texas. But I'm still getting the same level of growth that Texas is getting. So Texas is getting that growth as a state. Rogers is only getting it as a metro. So it's not the state of Arkansas that's comparable to Texas, but the Rogers market right now is comparable to just about any market in the United States in terms of its quality.
Wow. Okay. Okay. And what are some of the other efficiencies that you look at beyond, just beyond obviously having to fill and increase the occupancy is a huge piece, and I love the Facebook Market place for that. That's really neat what you got going there. What other levers are you pulling?
Several other levers, right? So one of the key things that we are looking at is supply, right? So you want to look at every single market and understand where the supply demand situation is. If there's a market that's creating, let's say, 50,000 new households every year, right? So, and these are anecdotal numbers. So, market one is producing 50,000 new households. Market two is producing 100,000 new households, right? So, and both markets have, let's say, the same rents, right? But market one, which is producing 50,000 households, has 10,000, new apartment units. But market two, which is producing double that households, still only has 5,000 units. So its incoming supply is much lower and its demand is much higher, right? So when you look at incoming supply, that makes a huge difference, because incoming supply is what drives rents the most. If your incoming supply is very low, then your rents are going to be spiking high. You're going to see 4, 5, 6, 7% annual increases in rents. Where if your incoming supply is very high, like it is in Phoenix right now, you might see 0% rent growth. Phoenix is even -1, -2% rent growth, because there's just a lot of supply coming in. So in our industry, understanding the implication of supply is very key. And it's not just multifamily supply, it's not just apartment supply. We've got to look at how are the local builders doing in terms of meeting the needs of the population. For example, I don't want to invest in a market where 90% of the people's incomes are sufficient for them to buy a single family home, because then I'm really competing with single family homes, right? And only 10% of the audience if everybody who wanted to buy a single family home bought one, now I'd only have 10% of the market as my renters because 90% went and bought a home. So I'm looking at markets where people have significant income, but the home prices in that market have gotten to the point where at least 30, 40, 50% of the people that live in that market with sufficient income cannot buy a single family home. So there's this gap, right? And they can't really bridge that gap, and that gap is maybe seven, eight, $900 a month when you look at the gap between what they can afford to pay and what the mortgage is. And that means that they can't qualify. Remember, banks these days are very strict with qualification. So that $700 gap basically is my cushion because I can then raise rents over time, closing that gap. I can go from 700 to 600 to 500. And I usually only need to raise rents once I finish building a property by about $100 to hit my goals. $100 a month. I hit my goals, which basically is to double investor money in 5 years. And so you're looking very carefully and you're tracking 323 metros saying which metros is the supply demand issue the worst. There's a big imbalance between supply and demand. There's a lot of household creation because those metros are doing really well. But unfortunately, the single family prices are so out of whack that they would need to drop by 20 or 30% for people to be able to buy those single families. Well, then what are their choices? Apartments or maybe my townhomes? And from what I can tell, 9 out of 10 people will pick a townhome over an apartment, even if the townhome rent was $100 higher than that apartment.
Yeah. Yeah, it makes sense. You just don't. You still have somebody that you're sharing walls with, but maybe not as much. And what about on the way those are laid out? And I'm sure it probably varies depending on the market. But what do you have a specific type of plan? I mean, is this an upstairs, downstairs? Is this two levels all on one single level? And are there yards? What is it? What is it?
Every single townhome plan I have is on two levels, and in there's a combination of plans. So there's a one car garage plan, there's a two-car garage plan, there's a one-bedroom townhome, a two-bedroom, and a three-bedroom townhome, and then there's a three-bedroom townhome with two-car garages. So you can think of them as four different plans within the same community. And the key is, why people like townhomes more than apartment is you never have anybody above you or below you. You always have a little backyard, right? So you can have your dog go out and poo there if needed, right? And then you've got, a garage. None of these things are available in apartment. These I find fundamentally are the top three things that people care about when they live in townhomes. Sure, you're sharing the left wall and the right wall. But if you think about it, 99% of the noise factor comes from people walking above you,
Yeah, that's
right?
true.
People are not walking on the left wall. They're not walking on the right wall. So if you look at the privacy issue, I would say more than 99% of them is basically about not having a person above you or below you, right? And 1% of is that you're sharing the left wall and the right wall. But in every other way, it feels like a single family home. It's got more windows because an apartment usually only has windows on one side, but your townhome has windows on both sides. And so there's a lot more natural light that comes into a townhome than can come into an apartment.
Yeah. Okay. And then tell me a little bit about on the average price home that you were mentioning when you're looking at some of these areas. You're trying to see kind of what the delta is between they have the ability to actually purchase something, and then there's some that maybe it's cheaper to go into the rent. About what's the average price per home that you're finding?
It varies from market to market, but here's a good template, right? This doesn't work in 100% of markets, but here's a good template. I'm looking for markets where median incomes are 60K or higher, and my average renter is somebody that has a 60 to $80,000 income, so 60 to 80,000, and basically rents a townhome for $1,800. So if you think about $1,800 a month, that's about $21,000, $22,000 a year. So if you're renting something for 22,000 a year, the average income that you need is about three times that much, right? So close to three times as much. So let's call it 66,000. Well, that's my ideal renter. He or she, it's a family. make 66,000. They like the fact that they want to live in a 2 bedroom or 3 bedroom townhome. Maybe if they make a little less than 66, maybe they make 60, then they'll go for my 2 bedroom townhomes. And that 2 bedroom townhome is going to be $100 cheaper, so they can afford that and they can qualify. And if they are, they've got maybe $72,000 in income, so they're a little bit higher, then they'll probably go in for the 3 bedroom townhome with a 2-car garage, so they have an extra garage, and the convenience that comes with that. And then the price is $100, a month higher. So, 3, 4 different floor plans allow me to fit people in from 60K in salaries to maybe high 75, 80K in salaries. But here's the key part. This metro, its single family median home price should be well above 300,000. If the metro's single family price is still in the 200s, then those single family homes are competing too much with my rentals, right? And so people might come live in my rentals for a year and then they basically upgrade and buy their own home. But by the time the average home in that market, average older single family home in that market is above the 350K level, then that 60 to 80K family can never qualify for that mortgage. Even at 4%, they'd have trouble qualifying. Today, mortgages are 7%. So they are now in captured audience for me, who, if they like my townhomes and I'm building brand new townhomes, why wouldn't they like them? They will stay there for 5 years or 10 years. And that's one of the magic benefits of having townhomes over apartments. And I'm not beating up apartments. I've built and bought thousands of apartments. I love them. But what I find is, people will live in an apartment for a little less than 2 years. It's very transitory, right?
Right.
Because it's a younger
Makes
audience.
sense.
Often they're not married. Often they don't have kids. Whereas the townhome audience tends to be older. They tend to have kids, are usually young kids, and so very often that audience lives in your townhome for about double the amount of time that the apartment that audience lives. And in our business, in the rental business, and this is not as well understood, it's all about the churn. Your profits are going to be high or low based on how often you're churning through tenants. If you can keep a tenant twice as long, your profits are going to be a lot more, a
Yeah.
heck of a lot more, because churn is the killer of profit in rentals. It's the fact that you lose a month worth of rent and then you lose another month when you're fixing up the property, and then the cost of fixing it up and painting it and doing all of those things. That's the true killer of profit. But what if a family stayed for 5 years? Well, then
Yeah.
that churn is much lower. And that's why I'm gravitating more towards townhomes today than towards apartments, because I'm fulfilling the American dream in a new way. The old American dream was to buy your own single family homes. Well, at least 18 million families can no longer do that because
Right.
of, the combined increase in home prices and interest, right? I mean, now interest rates are such that the mortgage is absurdly high, right? And even if they come down to 4%, well, home prices still went up 40+% in 3 years. So that 40+% already had got them out of that bracket, and now the interest rates are making things worse. So there's these American families that 10 years, 15 years ago, Keith, they would have owned their own home. Now they don't have a
Right.
choice. And so I'm trying to give them an in-between American dream of living in a townhome as opposed to living in an apartment. That's my mission. Mission 10K, to build 10,000 affordable brand new townhomes in fast growing secondary markets. And people absolutely love the mission, because my mission is not to build them in superstar markets like Austin, because then they would be very rent burdened. My mission is to build them in markets where they can easily afford the rent, but they cannot afford the single family home. And so I'm a true solution for them.
Yeah. Are you going in on raw land on these deals, or and doing the streets, the development, bringing the utilities in, or are you finding opportunities that maybe there's pre-platted subdivision lots and just buying a bulk of those at a time?
So most of the time it's raw land. So we go in and we basically go through the planning process. We call it the entitlement process, the city approvals, the permits. So we go through that entire process for most of our pieces of land. Sometimes we get lucky and it's already entitled, and that saves us a good 3 to 6 months. But there's still a lot of planning work that needs to be done to get it to shovel ready. And then we will, Mission 10K only brings investors in once we've taken care of all of that risk.
Okay,
So the
that's
investors come in after the post-risk portion. We have a company that has, I've raised $50 million from my investors, and that basically that company puts in the money, takes the quote unquote risk.
Yeah.
And once the property is at shovel ready, that company takes its money back and the investors put their money in. So that allows me to have very high velocity because I can work on 24 projects at the same time and not have to worry about raising money until the property is at the appropriate point.
Yeah, yeah, it makes a lot of sense. I'm sure the investors appreciate that as well. A lot of times it's two different directions. If you're going in development, you're going to be in there a lot longer because it's going to take a bit. But it sounds like you get it ready first,
Well,
so
also my
that's great.
investors are coming in closer to cash flow, right? Because
Hmm.
they're coming in when the building is about to go into civil and vertical construction. It's completely shovel ready. As soon as their money comes in, I'm in construction. Normally, that you're not in construction really for 12 to 15, 18 months after you bring in your investors because you still have to go through all the process of getting the land shovel ready. In our case, we already have our own money to do that. And so we don't bring the investors in until we're there. So that makes the projects A, shorter, and B, they get the cash flow much faster.
Very interesting. Let me ask you this, Neal. Is there anything that maybe we haven't already? I know we're kind of getting a little longer on the time, but any direction you wanted to go that we haven't made it to yet?
I think the only thing I'd like to say is I talk to a lot of investors every year. We've got 1,000 people that have invested with us. And I'm absolutely dismayed to see investors making the same mistakes that they made in 2008. So every investor, Keith, if I were to ask them this question of, okay, from a real estate perspective, you have a time machine, when would you like to go back to? The universal answer I hear is, I'd like to go back to 2008, right?
Right.
Because then I would just buy every single family home around. And the question that I would ask them is, do you know how hard it was to make anything work in 2008? Firstly, the whole world was against you. Everyone thought you were an idiot when you
Right.
were buying a single family home in 2008. Banks were against you. They wouldn't lend to you easily. It was actually an extremely hard time, but the opportunity was incredible. So today, in the last 18 months, last 24 months, I'm sure you're aware of this, because of that rise in interest rates,
Hmm.
we've seen distress in the multifamily arena. We've seen some challenges in the market. Things don't pencil out as much. And so there's investors who are basically saying, I don't want to invest. Why? Distress can only be an opportunity. An opportunity can only come during distress. So right now is actually a great time, especially for multifamily, where prices of existing multifamily have now dropped 25%
Hmm.
in 20 months. So in 20 months, prices are down 25%, but the income isn't down, Keith. The income's probably up 1%, 2% over that 20 months. It's not hugely up because, rents are slowing as well.
Yeah.
And so if I were to ask you, okay, Keith, you're buying a Taco Bell and it's $1 million in income, and so you're buying it for 10 million. And then 18 months later, it's still got $1 million in income, but instead of buying it for 10 million, you're now buying it for 7.5 million. Would you buy it?
Yeah. Every day.
Everyone would be like, oh yeah, I mean that's slam dunk. Of course I'm gonna buy that at Taco Bell, right? That's what's happening with multifamily today. And I see investors paralyzed the
Hmm.
same way that they were in 2008. My message for investors is there is no opportunity without some level of distress, right? That is what creates that opportunity. So 2 years ago, you were perfectly fine overpaying for assets when they were in boom markets and they didn't do well, and that's paralyzing you.
Hmm.
And that's the saddest thing that could happen because the way cycles work, if you get hit at the top of the cycle, guess what you should be doing? Waiting for things to come down and then buy again,
Right.
right? That's what averages things out, dollar cost averaging. And I don't see a lot of people doing that. And I think that's because they're more speculators than investors, if they really think about it.
Yeah. No, that's a fantastic point, Neal. I completely agree. And it's easier said than done. If you're hearing all around you about how bad it is, then it does sort of paralyze you. But you're absolutely right. A lot of folks are going to be kicking themselves, several years down the road where they should have jumped in and made it happen. So
Yeah, it's all about cycles. And again, you know, apartments, multifamily, townhomes, these are asset classes where the fundamentals haven't changed, they have improved. If I looked at apartment fundamentals in 2019 and apartment fundamentals in 2023, it's not even a close contest. What's changed in those 4 years is that we single family homes are now 40% more expensive. So roughly 10 to 20 million American families that could afford to buy a single family home in 2019 can no longer afford to buy it, even though their incomes are about 15% higher. Why?
Right.
Because their incomes only went up 15%, but the home prices went up 40%. And you might think, yeah, so home prices have to come down. They haven't. In the last 12 months, we've seen home prices come down by 1%. Why? Because almost all homes, 80 plus percent of them are locked in under 5%, 60% locked in under 4%. And that lock-in effect means that there's very few transactions. So it puts a big cushion under home prices. So I don't expect home prices to go down because those locked-in rates are locked in for 30 years.
Right.
And so I expect the home prices are going to basically sort of be where they are, maybe not go up, maybe not come down, sort of be where they are for the next 3 or 4 years. So there's still that gap between the 15% income gain and the 40% price. And so fundamentals for apartments today are vastly superior to they were in 2019.
Yeah, yeah. Yeah, that and even, regarding the price piece of it, it's also the interest rate. Has just this year has, doubled. And so that just more compounds what you're saying there. So,
Yep, higher mortgage, right? If you go from a 4% mortgage to a 7.5% mortgage, that's what mortgage rates are today.
mhm.
You need to qualify for a much smaller home, or you may not qualify at all, even though you were fine qualifying, 24 months ago. You may not qualify today. You might have a 10% higher income today, Keith, compared to last year,
Mhm.
and you still wouldn't qualify because the mortgage is 30 or 40% higher.
Yeah, yeah, that's a great point. Neal, how can people find out more about you? And maybe we didn't get too much into the multifamily university, but maybe in telling people how they can find out, maybe a little bit of about that as well.
Sure. So we are data scientists and we share our knowledge, we share our research on multifamilyu.com. That's Multifamily University. So multifamily followed by the letter u.com. And about 20,000 people register for our webinars each year. So, and those webinars are basically once a month. There are lots of other different topics. Sometimes it's single family, sometimes multifamily. Recently, we did a webinar on the office sector and how it's getting hit very hard and what the opportunities there are. So we do these webinars. They're completely free. There's no there's no subscription, there's no upgrade, there's basically no education product at all. It's just offered completely for free, and as I said, 20,000 people sign up every year. So that's probably the best way to engage with us, multifamilyu.com. And
Okay.
as you go through these webinars, you might find that occasionally we'll give you some information about projects that we're doing, and if that sounds interesting, join us. If you're interested in our key goal, the one that my heart beats for, you can go to mission 10k. That's mission10k.com, and you'd learn, something amazing about our mission to build 10,000 townhomes. It's by far the most profitable product that I've ever come across to build these kinds of townhomes. So I'm doubling down or tripling down on it.
Yeah, that's great. And got a couple other questions if you have just a minute. This is questions I ask every guest, and number one would be, what advice would you give somebody who's maybe just starting out in the investment game?
I think it depends on whether you're a limited partner or you're looking to be active. I think if you're looking to be a limited partner, don't be in a hurry. I find that LPs very quickly find somebody that they like and they basically start shoveling all of their money to them.
Hmm.
I didn't take that approach when I was a limited partner. We're talking about maybe 10, 12 years ago. I would basically get into their newsletter, so that I was understanding what it is that they were doing. And then I'd go basically talk to a second person, third, a fourth, a fifth, or sixth. I built a large ecosystem of people so that I could really understand how these people thought. And I learned a lot more that way. So I know I'm speaking against myself, financially for me, if you basically gave all of your limited partner money to me, that'd be great. But I think that's not the right way to do it. I think that you have to expose yourself to a much larger ecosystem. If you're trying to be active, then the best way is to get out there. I find that people are spending too much time in front of their computers. You need to be at the conferences and the conventions,
Right.
engaging with other, general partners, asking them how you can bring value to them. That's what works the best. And I present at about a dozen conferences a year, and I go to another half dozen that I'm not presenting at, simply because the what you learn there is absolutely remarkable, and it's very hard to get that sitting at your computer.
Yeah, that's great advice. And what about any book recommendations? Anything you've read recently that you want to share with the audience?
The Miracle Morning. I find that The Miracle Morning is a highly unusual book because it may never be your most favorite book, but it definitely, if you follow it, it will be the book that gets you to your favorite book. It will be the book that gets you to that aha moment that changes your life
Hmm.
because it gives you the structure that is necessary to keep learning.
I think that's great. Yeah, Hal Elrod, very good book. So, all right, Neal. Well, hey, I've enjoyed our time together. I really appreciate you taking the time to be on the Wealth Flow, and I know or I know the audience has got quite a bit of value out of everything that you've said. So, I will share how to get in touch with you on the show notes. Appreciate you, Neal.
Sounds good. Thanks for having me on, Keith.
All right, thank you.